Great. Well, thank you all for joining us. Looking forward to this. It's a very timely session today where we focus on the future of carbon in the Trump era and what that means for investing in global carbon markets. And we'll certainly have a focus on California today, given breaking news in the space, as well as our primary guest here today, which is Clayton Munnings. Clayton Munnings is an accomplished climate economist who has designed and researched cap and trade programs in 6 continents and has published over 4 dozen academic articles and research reports, and his previous positions at the World Bank, Kepros Capital, as well as at California Air Resource Board. So very well positioned to talk to us here. And today he is the CEO of Elevate Capital, a market intelligence company and a subscription service focused on California's carbon market. So there isn't a better person for us to have on the panel today. And following that is our regular collaborator, Eron Bloomgarden, who some of you know very well, who is the founder of Climate Finance Partners and also runs Emergent, which with the LEAF Coalition runs some of the biggest global jurisdictional reforestry projects in the world. So 2 very esteemed colleagues I'm very happy to share the virtual stage with today. Just a couple of housekeeping items. There will be Q&A, and we will strive to answer all of your questions. So if you are in the app and you can see the Q&A tool, please enter those questions directly there in Zoom. If you're streaming through the website, you can email us at info@KraneShares in order to send those questions to us. And there is CE credit. That CE credit is for CFP, CIMA, and CPD. And you can get that credit by emailing us after the program at ce@KraneShares.com. So info@KraneShares.com and ce@KraneShares.com for questions and CFP credit and any follow-ups that you have, whether it's materials or deck or anything else. And so I'm just going to kind of kick us off here. I want to make sure we leave plenty of time to get to the Q&A at the end. We're KraneShares, and for some of you joining, I know we've got a larger than normal audience today, so that's exciting for us, and thanks for joining us. But KraneShares is an asset manager that focuses on China and focuses on alternatives, and specifically within that alternative model, we focus on carbon, and we're the first to launch carbon exchange-traded products in the US. We have some of the largest, most liquid access vehicles into the carbon space. We have looked at this market for nearly 4 years, or over 4 years at this point, and we have a global product, which is KRBN, which is the global exposure to the 5 liquid major markets. That's Europe, California, the state of Washington, the state of California, and the northeastern states that are under the RGGI program. We also have a California-only program ETF, which is KCCA, and we have a Europe-only ETF, which is KEUA. And we've recently launched a European ETC, so a European exchange-traded product that is a replica of KRBN. So you can get that global exposure in both European and UCITS and 40 Act jurisdictions. It's a UCITS compliant vehicle in Europe. So what are we going to talk about today? Well, today, carbon markets, it's a $1 trillion market that is very underserved in most portfolios. But when you look at the fact that these markets all have a structured, engineered pathway to higher prices by design, the mechanism works as prices rise at a modest pace over time. And you'll see those returns are quite attractive. And also doing that and having that return with a correlation of something like 0.3 to US equities. So when you pair strong return with low correlation, you get something like a perfect alternative allocation. And that's why we've seen institutions and family offices, especially the sort of ultra high net worth single family offices, investing in this space, but yet it hasn't appeared in mainstream portfolios. And that's why we launched these ETFs. And then lastly, on this topic, not only do you have the risk return and low correlation, you also have, from an impact perspective, there isn't a more impactful way to invest. This is not ESG. This is not falling into some of those potholes that folks trying to invest in sustainable way fall into. This is purely a price mechanism that engineers lower carbon emissions within economies while rising in price, and that creates a great opportunity for investors. So with that, I don't want to hold back from getting straight onto Eron, who's going to take us through what this really means in a Trump environment, what's changed, and what's happening now in these markets. So over to you, Eron.
Great. Thanks so much, Luke. Excuse me. And I just want to underscore and build on what you just said. I mean, we really believe carbon is an asset class that should be strongly considered by investors of all stripe. So look, I'd like to set the stage. Clearly, we are in a different paradigm as it relates to climate action in the world with the new U.S. administration. Maybe I can start just with the headline, which is as follows, which is what you're hearing in the news, or most of what you're hearing in the news in terms of U.S. withdrawal from climate action, let's say withdrawal from the Paris Agreement, backpedaling on renewable energy finance commitments, removal of international aid commitments. While those are troubling, they do not directly impact the markets, the current global compliance carbon markets. There is, as we know, there is no U.S. national federal carbon market. The carbon markets sit outside of federal jurisdiction, right? So we have the European market, we have the California market, we have the UK market, we have the market, the so-called RGGI market in the northeast of the US. None of those are US federal jurisdiction. So there are some indirect impacts, which we'll talk about, but I want to start out with that as the headline. That said, the carbon markets are and have been at an inflection point over the last few years. And of course, they're heavily influenced by these political shifts. There is, and we've got to acknowledge and understand there is a retreat from the U.S. on climate leadership. And this raises some questions about the future of global carbon markets. This might lead to more motivation and more political will in those markets. It could also demotivate some of those markets. So understanding that we think is really important. That said, the existing compliance carbon markets, the largest are the EU, UK, California, RGGI. They have been in existence for a fairly long time. They have a strong track record of success, and they're not dependent on US federal policy. Further, and I think Clayton will touch on this in his comments, they have been challenged previously legally under the previous Trump administration, and they've unsuccessfully been challenged. So they're on relatively strong legal footing. There is strong precedent in the United States when we talk about the California RGGI markets in particular for state environmental programs, if they are more stringent than federal policy to move forward. So there are challenges, but there's also, we think, opportunities for investors. Fundamental supply-demand story, we think, remains very strong. There are very strong climate targets that these markets are driving towards, so deep reductions and constraints on supply. There's also floor prices in these markets, limiting sort of downside. And then I think it's worth reminding ourselves that support, even in the United States, public support for climate action remains strong. Next slide, please. So we, right after the election, we published a blog post that I thought it would be worth just refreshing, which is, if we put our bullish hat on, what are some reasons we think the Trump administration could actually strengthen demand for carbon allowances? First of all, state level independence. That's what what I was referencing earlier. The carbon markets in the U.S. and California RGGI are managed at the state level, and oftentimes when we've seen a vacuum of leadership at the national level, the states see as their responsibility. Certainly California, we've seen this, but many of the other states have seen it as their responsibility to lean in on leadership. Proven legal resilience, which I just mentioned, in terms of challenging and strong legal footing of these programs. The potential strengthening of these programs, And then, fossil fuel support. So, right, prioritization in the Trump administration of additional fossil fuel investments actually creates more emissions. And then in where we have carbon markets, that actually could increase carbon allowance demand because of the increased emissions. And then we've all seen that there is strong sort of, I guess, support in the Trump administration for tariffs. Well, one of the things that we've been talking about for a long time, and that we're seeing in Europe, for example, is a carbon border adjustment mechanism. So essentially a tariff that is based on the carbon intensity of the imported products. We think there is a window of opportunity there, actually bipartisan agreement potentially there, and certainly more rationale and tailwinds for in Europe and other places to put carbon tariffs in place. Next slide, please. I think it's worth some of you may be coming to these markets for the first time, and I thought it was worth just spending a minute or two on just the fundamentals. So backing up, zooming out, and first principle here is it's very important to understand the difference between a cap and trade emissions trading system and a carbon offset. These columns could also be labeled compliance, carbon compliance or regulated markets, and voluntary carbon markets. And these are characterized by the cap and trade emission trading system are regulated systems where there's a cap put over emissions, an absolute cap. That cap goes down over time. The regulator issues a tradable instrument, which is called an allowance, which the number of allowances equal to a regulated entity's emissions have to be handed in at the end of the year. There's no ifs, ands, or buts. There is a regulatory requirement for that to happen. And then regulated entities, regulated companies within that cap are allowed to trade those allowances among each other. And these are very strong markets. They're approaching $1 trillion in traded volume. That said, you don't hear a lot about them because these are fairly technical regulatory agencies making boring regulatory guidance and regulatory guidance. Whereas on the voluntary carbon offset side, you have that's characterized by typically large corporations who have made climate commitments using carbon offsets through emission reduction projects as part of their strategy to reduce their own emissions. Now, this is a much smaller market. That's the headline. Let's say 900 billion approaching a trillion to 2 billion, maybe lower market. That said, the carbon offset voluntary market gets a lot more attention because these are big household brand names. Think Google and Amazon and Microsoft, etc., making these high-profile purchases of fairly charismatic projects, reforestation, forest protection. Now, so I want to make that distinction because we are really focused in this conversation on the left-hand side of this column, these regulated markets. And so what you're hearing on the on the voluntary side is interesting. It takes up probably 90% of the media coverage, but really we think the more interesting opportunity for institutional investors is the left-hand column, these regulated markets. Next slide, please. And we're seeing that these markets, these compliance carbon markets, A, have been successful where they've been deployed. B, they have become the key tool for the regulators in those jurisdictions, California, Europe, elsewhere, to drive their climate policies. And C, they have been expanding their use within the jurisdictions where they've deployed has been expanding to additional sectors and increasing. And regulators really leaning into those markets. And then we're also seeing the global expansion, the geographic expansion of these markets into places that we would have never expected this to happen, including places like China and Brazil and Mexico, New Zealand, Australia. So we have over nearly 25% of global emissions now covered under some global, regulated carbon price. And this is enshrined now in the Paris Agreement, the idea that you can use carbon pricing, and there's even a mechanism in the Paris Agreement that can sort of link these markets. And so, there is a positive story here, even in the absence of U.S. Leadership on climate, for these this distributed market happening at a regional, at a country level, or even at an industry level basis, where we have, for example, action in the aviation sector. There's an aviation carbon market that is being implemented as we speak. Next slide, please. These are the core markets. As I say, these have been the European Union. In the case of the European Union, emissions trading system has been operating for nearly 20 years now. It is a $700 billion market. It covers a large part of the economy. California is the second largest market. It is linked with Quebec. And now we have the UK with its own market. That's after Brexit, and states in the Northeast through RGGI, that's been operating since 2009. And just recently we saw Washington State passing a cap and trade program and implementing their carbon market. So these are really the core markets that are that have liquidity, that have some size, and that are covered under the the ETFs that Luke had mentioned earlier. Next slide, please. I thought I'd provide a quick snapshot on price in the two largest markets, which is Europe and California. The pricing dynamic is complex. There are different commodity, gas, for example, commodity prices that influence this, and a lot of policy also influences this. So I wanted to give you a quick snapshot, but also explain a few of the dynamics that are happening here. One is California has a floor price that's implemented through an auction reserve price. Europe did not have that, and actually in 2019 implemented what they call MSR, Market Stability Reserve. It's a supply control measure that looks at the amount of credit allowances that are out in the market and can hold back supply from the auction. So that MSR was introduced in 2019. We saw steady, healthy price growth. Then in July 2021, the European Commission introduced a package of policy measures to tighten the program called Fit for 55. Those were tightening the program, more stringency, and you saw the price reacting to that. And then we had in February 2022, we had the Russian invasion, and there was pressure on natural gas prices. There was an energy crisis in the EU, and there was efforts for the European Commission to provide some relief to ratepayers through a program called Repower EU. They've actually pulled some supply from the future forward to provide some relief, and so you've seen sort of a relatively sort of flat pricing trend over the since then. Our view is, if you look at supply and demand, there is another opportunity here for an uplift. The question is when and how much, and we can talk more about that.
Eron, I didn't mean to interrupt, but just on that point, that Repower EU, you could almost put a circle from that Feb 23 to that May 24 sell-off that you can see there, sort of just right of center. Is Repower EU, where the market, because of the political response to the Ukraine invasion and the tightness of gas prices, kind of softened the tightening. And so what that's created is this lower price. And that period, that 3-year period, ends at the end of 2025. So that's why we're seeing that. If you see the trend in the latter part of the curve, is that it's starting to tick up. I think we're starting to see that turn around.
Yeah, thanks, Luke. California, Clayton is going to deep dive for us on California. I just wanted to point out two things. Again, these markets are not only driven by policy, but policy is important here. And there's two kind of policy bits here that I'd point out. One is, the regulators in California, the California Air Resources Board, they're responsible for the program. They have a responsibility to review the program from time to time, put out guidance. And so in July 21, there was a scoping plan that they put out, which actually had a whole host of measures to improve the market, and the result was really a tightening of the market, which led to, you know, this price uplift that you see after 21. Then you had some legislative updates in July 24, which, well, in aggregate, they've actually sort of softened the market for a variety of reasons. I'm sure Clayton can talk more about them, but just want to point to these, you know, a few of these milestones in these markets. Next slide, please. Okay, this is my last slide, and I just wanted to summarize here by where do we see some of the risks and opportunities coming out of this Trump administration. This is not exhaustive, of course, but if we look at the first one, if we look at the EU, you know, realignment and focus on defense and security, we're seeing in the UK, we're seeing across the EU. We are not seeing any retreat from climate, or either at the political level or the general public in terms of public support. However, the prioritization of defense and security could lead to the kind of backburnering of climate action potentially in the short term. Second, economic recession, if we are indeed going to an economic recession, would lead normally to lower output, economic output, and therefore emissions. Lower emissions would lead to lower, demand for carbon allowances. There is a focus on affordability and cost everywhere, but especially in California, and I think Clayton will talk more about that. Cost containment measures, relief for ratepayers, that could also lead to softening of the program. And then a prospect of global trade war, given the tariffs that this administration has been putting out, could lead to lower economic activity and then decreased demand for allowances. In terms of opportunities, look, the targets that these markets, right? So the markets are designed to help these jurisdictions, California, Europe, et cetera, meet their climate targets. Those climate targets remain strong and hard to achieve. And so the supply-demand fundamentals are sound. Meanwhile, they have this downside sort of protection in terms of these floor price or price support mechanisms. A bright spot from a carbon market perspective in the last election was Washington State. There was a ballot initiative to overturn the cap and trade program. It was rejected by 62% of the voters. So Washington carbon market is on very strong footing. It's moving forward. California, again, Clayton will dig into this, but we're expecting some clarity beyond 2030, some tightening.
We lost you there, Eron.
What? Sorry? Oh, you lost me. Can you hear me?
I can't hear you.
I can hear you just fine, Eron.
Okay, all right. Well, I'll just keep going and let me know if it's not working. So the California program, we're expecting some tightening, and Clayton will talk more about that. From a macro perspective, this, we've been talking about, with KraneShares, we've been talking about this concept of a carbon short squeeze for a while, which is basically the concept that the longer that the price is soft, the longer that we don't properly price carbon, the higher the eventual price has to be in order to reach our climate targets. So there's that. There will be increased pressure on other countries, subnational governments, regional governments, industry initiatives to lead where the U.S. is not leading. And we've seen that in the past, and I anticipate we'll start seeing that again. And again, the markets that we're concerned about, these compliance markets, are led by these other entities. The resolution of the Russian and Ukraine conflict could also lead to stabilization of gas prices, which could be very bullish ultimately for carbon prices in the EU. Linkage between UK and EU programs could happen and could be interesting, and especially in the UK price as it harmonizes with the EU price. And then stronger rationale, again, with the whole talk about tariffs, stronger rationale for carbon border adjustments. And by the way, those carbon border adjustments, so implemented already here in Europe, those are driving action, and those are one of the motivators for the expansion of carbon pricing, because the way those carbon border adjustments work is if you're importing from a country that has a carbon price, you're sort of exempt from those tariffs. And so that's driving action and motivating additional carbon markets. And then lastly, and I'll hand this over back to you, Luke, supply and demand at an inflection point where markets turn from structurally long to short. The markets tend to come out long to provide an easy transition into these carbon markets, and then they tighten up and go structurally short. And here I'll hand it back to Luke. I think you'll probably talk a little bit more about that. Thanks.
Yes, thanks, Eron. And thanks for bridging. We had a technical issue there where our line dropped, but we're back and no one else noticed, I don't think. So thanks very much. So with that, yeah, I think that as we go to the next slide here, it's a good opportunity for those that have joined that have heard so much there from you, Eron, and just maybe need a little grounding in some of the mechanics in this market. And so if we go back just one step to how these markets work and where this demand supply imbalance comes from, is to Eron's point that we have this legally backed framework. This is not a nice to have. This is not companies aiming to reduce emissions because it's the right thing to do. It's companies aiming to optimize for the cost of carbon in the various economies that they operate in. And you can see some of the names there. RWE, biggest energy company in Europe. You've got Chevron, you've got Shell, you've got PG&E, you've got PGE, which is the largest Polish power station. And we've got all of these like major global companies that are involved in these markets, both on a compliance, so they need to buy them, as well as a lot of these firms actually have trading desks in the same way that energy companies trade power and gas. They also trade carbon today. So this is where that $1 trillion of market size comes from, is the number of institutional participants. And to Eron's point, the voluntary market is nice, but it's only 2 billion. It's really negligible in terms of market scale. So how does this work? Well, these programs, they all operate in a very similar way, even though they're all a little different. The general concept is that there is a cap on the amount of allowances, carbon credits that are auctioned to the market. And the companies have to bid on those and can trade them with each other. And so historically, these programs launch by oversupplying. The idea is they want the price to be low, they want the system and the process to be easy, and they also want companies to be able to hedge, so buy more credits than they need. And they also want a vibrant market for these credits. And that's why it's an open market that allows financial players, because it's our job as financial players and investors to buy the undervalued asset and participate in its growth. And by us participating in that growth, we allow a risk transfer from the corporates and also allow for those companies to monetize the growth in the price of carbon. And so the mechanism works by slowly tightening over time the amount of credits that they auction to the market. So as the cap comes down, they're not actually telling people you can't pollute or you're not allowed to use oil or gas or coal. They're simply saying you can run your business like you do. However, you are going to have to pay these carbon allowances for each ton of pollution that goes into the atmosphere. So all that really does is tells companies that you have another thing to optimize for. They always optimize for how much energy they use, how much real estate they have, how many trucks they have, how many people they hire, but they never had to optimize for how much CO2 went into the atmosphere. And so all this mechanism does is puts a legal framework that you have to pay for and optimize for that amount of pollution. So what that does is just drive good behavior. It allows companies to hedge into the future, so they can say, look, we're not going to be able to cut our emissions in the next 3 years, but we will over the next 10 years. So we're going to hedge our future years, our price exposure to this market. And by doing that, they're able to smooth out the costs of decarbonization. And so, for example, great example, RWE, highlighted on the slide there, they have hedged all of their exposure to European carbon at 18 euros per ton. The current price is 69 euros per ton. So they have made a lot of money in hedging, being smart and hedging in this market. Some folks say, well, does that mean the big energy company gets to pollute at a cheap price? That doesn't sound good. Well, this is the beauty of a capitalist framework around this issue, is that it does work because they can keep polluting and use these credits that they paid 18 euros for, or they can trim their pollution and sell these credits for 69. And so, of course, if you're a shareholder or you're the CEO of that company, you're going to demand they optimize to make the best return. And so the best return the company can make in this case is cutting their pollution or figuring out ways to capture carbon or investing in ways to reduce their carbon footprint in some other way. And so by doing that, you just create economic incentives. And we are given the economic incentive as the investing financial market to participate in that growth because it's our job to create the price discovery. And that's what makes this so compelling as an investment, regardless of whether you're thinking about the impact side of this or not. But that said, there is no bigger impact. You know, people have talked about, you know, selling oil companies or not buying companies because of various ESG metrics. None of that's really been proven to have any real effect on returns. And in fact, arguably adds to your risk. What we do here with carbon is give you a pure play on that price of carbon, which is structured to change, is structured to rise because the market is always tightening and will allow the price to rise and companies to essentially work out of their high emission industries. That doesn't mean those industries go away. It just means they find ways to do that same output, but with lower emissions. So here's the three ways this really has a lot of impact. The rising price of carbon. The governments are auctioning those credits. So when they auction those credits, you get this war chest. And that war chest is where your rebates on EVs come from, or where the discounted solar panels or the free solar panels that you can have installed on your roof comes from some of the money that is gathered in these programs, for example. And you also get high-speed rail, you get social climate funds, you get wetland and watershed restoration. All of these needed practices can be funded from the money that the government raised through the program. Secondly, you have this basic mechanic that if you put a price on something, people start trying to figure out how to not waste money on that thing. So when you are burning, and the easiest example is if you're a power station burning coal and you're a power station burning gas, the gas power station has to buy less credits because gas, when you burn it, for every unit of energy, it has half the emissions of coal. So the dirtier fuel has to pay for more carbon credits. So they start to get handicapped. So either they can not do anything about it and they become less and less competitive over time, and the gas companies do better and better and they proliferate over the coal. Or if you're smart, you realize that there's a very easy cost benefit analysis and you can switch from burning coal to natural gas. And by doing that, you're reducing your bill to carbon credits. So that's how you naturally, using a price mechanism, move people along. And ultimately what that does is make renewable and cleaner energy cheaper relative to the dirtier fuels over time as that price of carbon rises. But the third and sort of most powerful part of this is as that price of carbon rises, it starts to make economically viable all of these other technologies that need to be developed in scale. So we're seeing, because of this rising price of carbon, a huge investment in energy storage, modular nuclear, carbon capture and storage, renewable technology. There's a lot of innovation, you name it, whether it's steel, cement, glass. People are innovating to reduce the carbon footprint of those products so that they can optimize and benefit from this price of carbon. So it really creates a massive flywheel. And when they did this in the 80s with acid rain, this is how they solved the acid rain program. They put a price on the pollution that caused it. And then for every dollar spent in the program, $3 were invested in reducing the problem. So you create the economic incentives to decarbonize without having to force anyone or tell anyone what they need to do, because that is inefficient. But you let the price and you let the capitalism and free-flowing market realize that the best thing that you can do is reduce your emissions. But now, before I hand over to Clayton, I do want to talk about this because I sometimes, half jokingly say to people, forget it's carbon. I'm going to blindfold you and I'm going to describe an investment and tell me if this sounds like a good investment. So carbon has historically returned about 20% a year. This is the blended benchmark that we use in our flagship KRBN. It's about 20% a year with a vol, which is an elevated vol, about twice that of US equities. But the returns have been about twice that of US equities. So you end up with a Sharpe ratio that looks very similar to large cap US equities, which is being the best thing that you could have held pretty much through most of our history. That said, the correlation is only at 0.3. And this has been consistent. There's been, you know, a lot of vol. There's been events that have made short-term sort of correlations look like they're correlated, but this 0.3 has held through this whole period of time. So if you can get US-like sharp, so risk and return like US equities, but with a 0.3 correlation, you've created something very special for your portfolio, because you're not sacrificing return, but you're drastically reducing the volatility of the overall portfolio, despite the component itself being quite volatile. And you can see there the individual markets have almost no correlation to each other. Each of these programs has different mechanisms, different demand supply imbalances. Each economy has different energy sources, different energy usages, and that's why these programs are all quite different. The other thing that people ask me about as well is the cost of holding a position in carbon, because they think it sounds like a commodity. It sounds like it's close to gas and oil and coal, the opposite of them, but it's related. But the reality is it's a financial asset. It's cheap to hold, cheap to move. And so in that case, it's more like a currency than it is a commodity. And why that's important is if you want to be long natural gas, you have a very difficult futures curve that can be extremely expensive. Same for oil, same for most commodities, where it's often not going to be economically viable to hold that commodity long term. Even if you believe the price is going up, the cost of holding is greater than the return that you can make. With carbon, it's the opposite. The curve is flat because there's no storage, there's no transportation of heavy commodity. It's literally a financial asset. And so the futures curve is very flat. It looks something like the treasury rate. We get long futures in this market that only need a small amount of margin, and we get to invest the rest in very safe, very short duration bonds that allow us to make back that shape of the curve. So it's actually, as you can see here, the cost of the curve is currently 0.9, so under 1% to be long this futures market. You talk about commodities, you can get into big double-digit percentages in terms of cost. So this is also a very good way to be long that energy story. Why is all of this so important? Well, sometimes people say to me, where does this fit in a portfolio? One easy place is you replace commodities, because commodities are expensive to hold and they don't really have expected long-term returns. They're just an inflation hedge. With carbon, you get all of those same benefits, low correlations, hedged to inflation, but they are designed to rise in real terms and in a material way. So by having this in a portfolio, you reduce vol, you increase return, and you can shift that curve out and to the left. And we've also seen people use these as an overlay to their equities. We've seen people use this purely as an alpha play. They understand the story, they see the return profile, and they want to be long. And we've also seen people just say, this is an alt. This can be in place of commodities. It can be in place of private investments. This can be in place of managed futures, anything like that. This fits in an alt bucket. So I'll pause there. I will come back at the end with some sort of forecast information. But with that, Clayton, we'd love to hear from you and everything that's been going on in this California market. I know a lot of people, that's their number one focus.
Yeah, sure. Thanks, Luke. So I think I will keep things. I'll try to keep things to 15 minutes or under, so we leave time for Q&A. I'll also keep things high level so we can tick through everything. And I'm going to go chronological. I'm going to explain how things typically work in California, how they've worked over the last year or two, now that affordability is a key political issue, and then what's the news over the last 24 hours. So what's happening presently. Before I jump into all of that, my training isn't as a climate economist, and I just have to say the scientific evidence says the California cap and trade program is working very well. It's reducing emissions at least 15% compared to counterfactual emissions, according to the best econometric studies I can find. It's doing so very cost effectively at around $30 per ton compared to other regulatory or subsidy-based approaches, which are often several hundred or several $1,000s per ton. And one of the fears that we had when we built the California cap and trade program is whether local air emissions hotspots would occur. And when you look at the evidence, there is no evidence that the cap and trade program is creating local air emissions hotspots. Instead, I think the weight of the evidence shows that the California cap and trade program is decreasing local air emissions and decreasing local air toxins. So that's the obligatory Economist take, kind of what the academic literature from the last 2 years really says about the performance of the program. So 2 thumbs up from the academic literature as far as I'm concerned. So going into kind of contemporary issues, CARB typically, kind of as Eron nicely outlined, the way there are no hard and fast rules really on how the legislature, the governor's office, and CARB all interact. But like roughly what has been the practice over the last 10 plus years of this program is somebody makes an aggressive climate target. Sometimes it's the legislature via a new bill. Sometimes it's Governor Newsom via an executive order or announcement. And then CARB interprets that new ambition and says, well, we need to lower caps to kind of align the economy's emissions to hit this more ambitious target. And that's exactly where we all thought we were about 2 years ago when CARB updated its scoping plan, which Eron referred to, finalized it in 2022. And then we saw a big splashy press release from Governor Newsom saying, we actually don't need to, on the books right now, we have a 40% reduction by 2030 target. I think with this new scoping plan, we can hit 48% by 2030. And then, so what you see in 2023 is kind of some anticipation of CARB lowering the caps. And what you see in 2024, late 2023, is CARB starting informal workshops to start thinking through how they will update the cap and trade program to hit this more ambitious 2030 target. Now, if you look at the price over the last 3 or 4 quarters, well, so I'll say this expectation kind of drove the all-time high price in California. So the expectation that CARB would lower caps to hit this more ambitious 2030 target brought us to all-time highs of around $41 at the beginning of last year. What we've seen since then is prices dip, depending on where you start, around $10. And what we do at Elevate Climate and through our subscription service is really follow the regulatory process. So with that lens on, there are other things that affect prices. There's technical features, macro features, but with the regulatory lens on, it seems in our view that most of that net dip, the $10 that roughly has been shaved off of the price, comes from regulatory news, and mostly in the form of regulatory delays. So in our view, depending on how you count, there are probably 4 or 5, maybe 6 signals of regulatory delays over the last 3 quarters. This has led to lower auction revenues by, in our estimation, about $1 billion over the last 3 quarterly auction revenues. And the question is really, what's the cause? Because CARB doesn't typically delay their rulemaking processes several times. I mean, delays are common, but to delay 4, 5, 6 times over the course of 3 quarters, that's not common. So that brings us to what has really been different about the last year or 2 in California. And it's not a simple answer. There are multiple factors, but the bedrock factor is that affordability is a bedrock political issue now in California. If you live or have visited California, you know it is expensive here. And even before anything on California climate policy, the Republican news kind of angle, the Fox News angle, is critiquing California for being an expensive place to live. When it became clear Newsom has kind of presidential ambitions, I think those news angles from Fox News ramped up and the affordability critique became heightened. Again, before any climate policy issues, the spat between Newsom and California's oil sector heightened. And then what we see when climate policy updates that are typically easy came to the fore, that affordability got tangled up with market-based climate policies. And where we saw this most obviously was the low carbon fuel standard regulatory update. And what you saw as CARB underwent that update is if you lived in Sacramento and just walked to a couple bars, you would see billboards from the Western State Petroleum Association complaining about the increased gas prices and how it's due to state taxes, how it's due to the low carbon fuel standard, and in some ads even mentioning the cap and trade program. So you had billboards and flyers kind of all across California, just connecting affordability with market-based climate policy. And the result of that is the LCFS was, compared to a typical CARB regulatory process, really politicized and really slowed down. At the end, the LCFS update got approved by the CARB board, but 2 members voted against it, which is very unusual. And there is a hang up now where the last step in the regulatory process, when I was at CARB, this step wasn't even thought about because it's really supposed to just be paperwork. But the OAL, Office of Administrative Law, just had some feedback for CARB on the LCFS. So the rule even today isn't completely done and dusted, although I expect it will be done and dusted. So in short, this affordability political issue really impacted the LCFS regulatory process. And in turn, in part because LCFS took so long to kind of get done, that contributed to cap and trade regulatory delays. Over the summer, the legislature started realizing that the regulatory delays were causing allowance price dips. And in particular, the Senate, I think, values the revenue from those quarterly auctions. And so you saw over the summer, the legislature kind of step in as CARB was flagging. And you saw a statement out of Senator McGuire's office, the pro tem on the Senate side, saying that, you know, we want 2025 to be the year that we legislatively extend the program, that we eliminate the sunset that legally ends the program in 2030. So you see the legislator kind of come to the fore. And that really brings us, oh, and by the way, this is not in just a superficial way. The Senate started a working group late last year, which we've been giving some advice to from an expert perspective. And then the Assembly started a working group early this year to kind of work through what a legislative extension bill would look like. And in legislative speak, a working group just means you're starting to get serious about creating a meaningful bill. So I think that brings us to where we are today. So CARB has kind of continued to delay, and what you see is the legislator continuing to act and to pull forward. So on February 21st, both the Senate and the Assembly introduced what are called spot bills. So these are very short bills. And the Senate version says, more or less, we intend to reform and extend the cap and trade program. And the Assembly bill more or less says, we intend to extend the program. There's a lot hanging in the difference between those phrasings. The Senate in 2017 was quite adversarial towards the cap and trade program. And their version of a reformed program, the last time they extended the program, initially included ideas like eliminating allowance banking between years, eliminating free allowances, eliminating carbon offsets. That initial bill got killed, but it was very adversarial, and the Senate kind of took an extreme view of what the cap and trade program should look like. So you see and for reference, spot bills are really placeholder bills. So they're not meaty. This just gives both the Senate and the Assembly an opportunity to come up with a meaty extension bill before the end of this year's legislative session, which is in August. So you have a legislator really stepping forward in meaningful ways. The news recently from CARB is that they had on their website until yesterday around noon, so this webinar is particularly well timed, that they expected the regulatory package to come out, their regulatory package on cap and trade. They were working towards an early 2025 date to release that. That website has now changed, and it says we're still working through the regulatory package and expect to move forward this year. And then goes on to say, at the same time, the administration is working with the legislature as they consider extension of the cap and trade program. And Leon Randolph, the head of CARB, in a Politico Pro interview elaborates on kind of some of the thinking behind that. In my view, this is a bit unprecedented. I've never seen the legislature mentioned on a regulator's website, but I think this positioning from CARB makes sense because first, I think both the governor's office, the administration, which is the governor's office plus CARB, and the legislature probably want to avoid an adversarial and controversial legislative extension, which is what happened in 2017. So there seems to be good sense in trying to collaborate with all branches of government, especially when the Trump administration is looking for targets. And I don't think so. To go back to one of Eron's points, I think those targets are more media and political, less legal and policy. So I'm looking at this through kind of a media lens. So I think it makes good sense to put out this statement. Clearly, CARB is trying to be more collaborative and is trying to take a unified approach with the legislature in terms of updating this program. And I think that's all fine and well, and all else equal, I think is positive. Now, what does this mean in terms of the speed of releasing the rulemaking? It could mean that the rulemaking comes out slower, but I view this as CARB and the legislature ostensibly agreeing that the political issues should be avoided. And in the background, that issue of affordability is going to stay very present. So I hope that this positioning means that the California decision makers are kind of working in unison to update the program to hit the 2030 targets, to extend the program beyond 2030, and simultaneously to kind of address the affordability critiques that are definitely going to come when the regulatory update and legislative extension occurs. I think that's less than 15, but we only have about 5 minutes left, so I'll stop there.
Thanks so much, Clayton. And I'm going to have just 2 more words, only because I can see some of the questions, might be answered by this, and then I want to get back to some questions for you, because I think that's what everyone wants to hear. So here we go. So very quickly, guys, this is so this is just the California market that we talked about. And some people have asked me why, despite everything that Clayton's talking about, why have prices been down? And I'll very quickly just point to this point in the curve. So this is the surplus in the market. And we had, prior to 2024, seen this market rolling over into decline, i.e. shrinking surpluses. And that's what is the catalyst for prices to rise. But with the delays that Clayton talked about, we saw that curve sort of flat rather than rolling down, and we don't see the rolling down until next year. So that flatness in the curve, or flattening of the curve relative to consensus, is where we've seen the prices fall off in 2024. Let's not forget, I think the return in 2023 was something like 34%. So we saw the strength coming in 2023. The delays in policy have given up those returns, but this return to extension, to clarity on the program is what we think will be the catalyst for markets to return back to those sort of pre-2024 prices over time. And then just something I want to show here. This is what's so critical about the California market. There is a floor price, there is a ceiling price, and there are a couple of resistance tiers. So why we're getting so many calls on this is that current spot prices, there's very little downside. So we're trading about $30 a ton. The floor is at 26. The ceiling is at 94. And all of these move by 5% plus CPI each year. So I won't spend too long. I love talking about this because it's such an asymmetric sort of set of outcomes. But with that, I just want to kind of get back to the products we offer, the global, the California, the Europe, and I'm going to dive into some questions. And Clayton, I know I've got a bunch for you. Eron, I know you've got a hard stop, so I'm going to dive straight in here. Just spend another minute of 30 seconds if you can on the one question here. CARB has adjusted the language on its website from I saw early 2025 to this year. How do you think the market is responding to that?
Yeah, sure. I mean, the news broke last night in Politico Pro and then the Politico Climate newsletter. So I would just say look at your desktop. I don't watch the prices with that kind of fidelity. Um, I could have a go at a couple other questions. Like there are some questions in the chat that are more like how could Trump attack the program? Either through political or funding threats or legal threats. I'll just reiterate, the last time Trump attacked the program was to sever the California-Quebec link. At the time, I was working at the International Emissions Trading Association. We raised money to co-defend that link alongside the California Resources Board, and we convincingly won that lawsuit. Trump could bring that lawsuit again, but I think, again, California will convincingly win that lawsuit. I don't think the threats are legal. And I don't think right now cap and trade is on the Trump administration's radar. So I don't think there's a threat that Trump withholds funding if cap and trade moves forward. I think all of this boils down to mostly media. It's mostly the media outlets that are the focus. And it's really the affordability narrative, which is what has been discussed in California for the past 2 years. We have high electricity prices. We have high gas prices. I think the decision makers are all looking into how do we lean into market-based policies, which we know are the most cost-effective, most powerful tool we have in our portfolio, knowing that they visibly increase commodity prices. How do we solve for that politically? And anyone has any ideas? I'm all ears. It's a tough political knot, but I think that's what leadership will look like in California. How to figure out how to say yes to a rulemaking update and a legislative extension update, given the affordability concerns and who we have as President Trump federally. Yeah.
I'm gonna make one quick follow up on that, and then a quick plug. Without weighing in on the uncertainty of who's making decisions in DC and the Elon Musk effect, I just wanted to point out Tesla has made a huge amount of money from environmental markets and from carbon, and it's been not a trivial, a very meaningful part of their revenue makeup. So just to point that out, and who's now calling calling the shots. I do have a hard stop, so I apologize, I'm gonna have to jump. I do want to just do a quick plug for Elevate Climate and Clayton. Obviously, he's extremely well. If you're interested in tracking the California market, they've got a subscription service, as he mentioned, and if you really want to deep dive and dig in, it's probably the top of the pack for that. So just wanted to do that before I leave. So thank you, Clayton, for joining us.
Thank you, Eron, and thank you, Luke. I also have a hard stop.
Great. Well, for everyone listening, thank you both for joining us. Everyone else on the call, if you've asked the question and you've added your name, we will get back to you and answer all of these questions with you, and happy to do follow-ups. Everyone can have the deck if you just email us and request the deck, info@KraneShares.com, and we'll get that deck to you. So these questions that and if you put anonymous in the thing, if you just email us info@KraneShares.com, we'll get back to you. So please do feel free to keep the questions coming. Hopefully we answered them. Clayton, having your insights on this is always incredible. Eron, as always, great seeing you, and thank you very much.
Thank you, Luke.